Hey everybody, welcome to the Careers in Finance series. We're going to talk about how to be an investment banker. Get ready. Okay, before we get started, first a little bit about me. 25 years in finance. I was an accounting major, an undergraduate. I got an MBA in finance. Now, I remember the crash of 1987, the big stock market crash. Many of you probably don't know what I'm talking about. And I presume you know 1929, right? We had a big crash and depression then. And if you don't, you need to Google that. But 87 was a bad year. Lived through the 2001 dot-com bubble and crash then. And then, of course, the financial crisis in 2008, or beginning in 2008, when Lehman Brothers and Bear Stearns, two huge investment banks, melted down. I remember all that. But you know what, guys? I'm really not that old. So I'm still a young guy. I'm formerly a managing director of a middle market investment bank on Wall Street. I've got an experience ranging from mergers and acquisitions all the way to capital markets, which just means that I've worked on IPOs and things like that. Currently, I'm in a financial advisory and generational wealth management business. I have my own firm and advise a handful of high net worth business owners on their company and their personal finances. I'm a SKAITUBE LLC sponsor and big supporter of financial literacy for Gen Zs. So what is investment banking? First off, let's not confuse investment banking with commercial banking. A commercial bank is what you guys know and are familiar with, right? You have money, you go down to your bank, you make a deposit, you put it in the bank. You're buying a house, you go to the same bank, and you ask for a loan, a mortgage, so that you can buy that home that you really want. That's what a commercial bank is. That is not what an investment bank is, right? So commercial bankers provide companies, right? Because now we're talking in the context of companies, with bank loans. And when companies have cash because they're making money, they need somewhere to put it, and they put it in a commercial bank. Investment bankers are something different. Think of investment bankers as intermediaries. And they're intermediaries that companies hire to represent them in financial transactions. So here we have a commercial bank. We have a company there. They make money. They deposit their cash in the bank because that's where it's safe, right? They don't want to leave cash lying around. Or now, of course, everything's electronic, but it's flowing through the bank. And they're looking to expand, and so they need money, and they go down to the same bank and they ask for a loan. And the bank gives them a loan, provided they're a creditworthy company. And that's what a commercial bank does. An investment bank is the company's intermediary. So now the company wants to go public through an IPO, which is called an initial public offering. They want to raise money from investors like you and me. So they hire an investment bank to represent them, to essentially help them package their company and structure their company so they can sell stock to investors, you and I. Okay, so before we go forward, let's take a step back and look at history, and just bear with me here. Over the course of Wall Street history, we've seen this combination of commercial banking and investment banking. So what I mean by that is there was a period of time when commercial banks and investment banks were allowed to operate as one company. And then there was a period of time that they were not allowed to operate as one company, meaning that if you're an investment bank, that's all you could do. You could not be also a commercial bank, right? So the Great Depression caused a lot of economic turmoil. And a lot of economists, a lot of people, business people believed in Congress, believed that some of it, if not all of it, was caused because of the structure of banks. Banks were allowed to be both investment banks and commercial banks. And we're going to show you an example why that may be conflicting. So in 1933, Congress said, no, we're not going to do this anymore. We're going to pass the Glass-Steagall Act, which separates commercial banks and investment banks. So in 1933, they separated. They said you can't be both. You can either be a commercial bank or an investment bank. And that lasted until 1999, when that Glass-Steagall Act was repealed by Congress. Okay? But then again, and maybe in part because of the 2008 financial crash and crisis, maybe because of that, in 2010, Congress passed the Dodd-Frank Act. And in the Dodd-Frank Act, they still kept commercial banks and investment banks together, meaning you are still allowed to do both businesses together now, because again, remember in 1999, Glass-Steagall was repealed. So now investment and commercial banks could be one company. So they still allowed this under Dodd-Frank, but Dodd-Frank specifically said there has to be some separation between the two businesses internally. Okay, so again, they went back and said, well, we think this might cause some issues. So we want you to even though you're one company, we want you to separate the businesses internally so that they're operating, in left side and right side. Now, this separation of banking, commercial banking, investment banking, and then bringing them back together, and then now kind of separating them again, is kind of this historical cycle. And we see it come and go because of what's happened in the markets and what happens when you combine banking and commercial banking together. So let's take an example. JP Morgan, right? They're an investment bank, and they're also a commercial bank. They provide advice to ABC company that's looking to buy another company. So JP Morgan's M&A bankers go and they provide this advice, and they charge a lot of money to ABC company for helping them figure out how to buy this other company. On the other side, JPM's commercial bankers come in as a team with the M&A bankers, and they said, let me provide a loan. I'll give you money to make this acquisition, right? So it's a package deal. Now, is this a good thing? Is this a good thing to do? Is this a good package deal? It's kind of a great package deal, right? From the bank side. I mean, you're making money on the left hand, the investment bank, from fees providing advice. You're making money on the right hand side from commercial banks because you're extending a loan and making interest income from that loan. But what behavior might this motivate, right? So let's say ABC comes back and says, you know what? They raised the price. The target company wants more money. They want more money, but we still want to do the deal. So JP Morgan, you guys have to give us more money. So the M&A banker says, you know what? This deal is still a great deal. I'm going to make a lot of money if you buy the company. So he calls up his commercial banking colleague and he says, you know what? We need more loans. We need more loans because the price is now being bid up by the target company, and ABC company needs more money. So the commercial banker says, well, that's kind of risky, right? And the investment banker says, come on, Joe. We're all going to make more money here. You're going to make more money giving them more loans. I'm going to make more money providing advice because now the price is higher. So this is great for JP Morgan as a bank. Let's do it. So everyone agrees to do it. And now ABC company gets their loan. They buy the company. Everyone is happy. Everyone is happy. But think about this. What happens when every single bank starts to do this? When every single bank starts to do this, now bear in mind, more loans means what? More risk. So now when everyone starts to do this, you've got risky loans out there. Riskier and riskier loans out there because investment bankers and commercial bankers are working hand in hand because they want to do the deal and they want to make more money. And now you have a market full of risky loans and bad advice, right? And so I'm being a little bit dramatic, but that's the example where you can imagine an investment bank and a commercial bank being, one in the same family can create behaviors that are not great for the market as a whole. Okay, so what is an investment bank? Well, an investment bank is really a diversified financial services institution. It's really engaged in about everything. It does everything, right? And we're going to get to that down the next few slides. Here you see a couple of the top investment banks, JP Morgan. And if you look at the JP Morgan logo on the right side, there's that blue kind of circular logo. That's Chase. That's Chase Bank. Right? So it's now called JP Morgan Chase. And so Chase is the commercial banking side and JP Morgan's the investment bank. And when they merged, it became JP Morgan & Co. or JP Morgan Chase. I mean, they still call the commercial bank Chase. So it wasn't founded in 2000. JP Morgan is a really old bank. So is Chase. But because they merged, I believe, in 2000, that's why it says it's founded in 2000. Same with Merrill Lynch, B of A, Bank of America, Merrill Lynch. Bank of America is the bank, the commercial bank. Merrill Lynch is the brokerage or the investment bank. And here you see a few other names you probably know of: Goldman Sachs, Morgan Stanley, Citigroup, a couple of the foreign banks: German bank Deutsche Bank, Swiss bank Credit Suisse, UK Barclays, all very well-known investment banking outfits. So what do investment banks really do? Well, the first thing is that they take companies public. I think this is probably the easiest example. You probably know this example the best. So they help companies go IPO. They act as a middleman between the company and the investors, right? They also provide research analysis on stocks to investors. And so what that means is that they hire a whole bunch of really smart people to write research reports on stocks. And these research reports tell investors, well, is this a good stock? Should you buy it? Should you hold it? Should you sell it? What is the expected price that the stock would reach? And so they do a lot of analysis. They do a lot of company financial projections. And these are also what we call research analysts that work at investment banks. The other things that banks do, I'm going to kind of skip down to some of the highlighted ones. They trade securities with their own capital. So this is what we call proprietary trading. Investment banks have a lot of money. They have a big balance sheet. And so they use their money to also trade themselves for profit, right? The other thing they do is they manage money on behalf of clients. So if you've got a lot of money, if you've got $1 million or $2 million, you can go to Goldman Sachs and say, listen, can you manage my money? And you hand them the money, and their job is to invest it for you and deliver an annual return that's acceptable, right? And this is what we call private banking. If you've got 50 or 100 million, then you're a key client, and they take you out to dinner and they schmooze you, and because they want your money. The last thing is they provide mergers and acquisitions. We gave that example earlier, and these are companies that look to buy or sell. So if you're a company that's looking to buy another company, or you're a company that's looking to sell yourself, you would hire an investment bank, like an agent, to represent you and to help you negotiate with the other side. And I skipped a few points there, but we're not going to talk about those. But there's a lot of other things that banks do as part of their normal functions. What are the different types of iBankers or investment bankers? And this term investment bankers is a very general term, because the truth of the matter is that iBankers are very specialized, right? And I didn't know this before I got into the business, but that's what it is. And they're specialized because everything's quite complicated, and you need to be specialized in order to be really good at it. So if you're going to take a company public, you have an investment banker help you, and that banker is specialized in taking companies public, in issuing stock to the public or to investors. If you are looking to buy a company, or you're looking to sell yourself as a company, you're going to hire a banker, but that's what we call an M&A banker, a mergers and acquisitions banker. And they specialized in buying and selling companies, not taking companies public, right? So that's a different type of banker. That's an IPO banker. If you're looking to raise debt, right? And by that, I don't mean a bank loan. I mean you go and sell debt to investors, because investors not only buy stock, they also buy bonds. So that's what we call leveraged finance, and there are bankers who specialize in that. And lastly, as an example, municipalities, right? When municipalities want to build infrastructure, let's say build a road or a highway, they need money. Where do you think they get that money from? They get it from investors, and they hire a banker. This is what we call public finance, who go out and raise this money, and investors invest in it and give the municipality the money, and then they go and build the road. And then when they build the road, they collect tolls, and with the tolls that they collect, a part of it goes to repay the debt, the bond. All right? Other positions that are not called investment bankers but are important inside an investment bank, we have the research analysts, which we just talked about. They provide research reports on stocks. Sales and trading, these are people who essentially trade stock and securities, and it could be for proprietary trading, which is the bank's own money, or it could be for clients' money. Then we have the private wealth manager. In the old days, we called them brokers. Now they're called private wealth managers. And this is my example where if you've got $2 million, you go to Goldman Sachs, they assign you a private wealth manager whose sole job is to help you grow your money and make sure they answer any questions that you have. right? And then you have an asset manager, or some people call it the investment manager. And these are the people who actually invest the money. So your private wealth manager, think of them as a customer service person. They really know you very well. But your money goes into Goldman, it's actually allocated to someone whose sole job every day when they wake up is to invest that money and track the markets. All right. So these are the different types of jobs within an investment bank. Okay, so you're 21 years old or 22, you just graduated from college, you got admitted to Goldman Sachs Investment Banking Analyst Program. It's a 2-year program. And by the way, this is a real thing, right? All the big banks have what they call the 2-year analyst program. It's a 2-year contract. They hire you right out of undergraduate school. And this is what you're going to do every day, right? Financial modeling, number one, and a lot of this. I mean, if I were to allocate percentages here, I would say the first 2 bullet points are the majority of what you're doing. You're doing a lot of financial modeling. What is that? So when a company goes public, for example, that's the easiest example, investors want to know, well, how are they going to perform? Is the company going to grow? Are they going to have more revenues, more profits next year? So you have to do a projection, right? You have to project out into the future what the company is expected to generate in sales and profits. And that's what modeling is. You're on an Excel spreadsheet, very complicated Excel spreadsheet, and you're modeling this out. You're modeling how much, for example, Apple, how many additional iPhones I'm going to sell in the next quarter, in the next year, and how that translates into profits. And that determines whether or not this is an attractive company, not an attractive company, whether or not they're going to be able to sell an IPO or not, right? So all day you're doing these financial modelings for a whole variety of different companies. You're also writing and preparing deal presentations, what we call pitch books, right? And the reason you're doing that is because investment banking is a transactional business, right? It's a deal business, which means there's a start and there's a finish. Once you finish the deal, once you finish the IPO, once you finish buying the company, or once you finish selling the company, the deal is over. You collect your fee for that transaction, or the bank does, sorry, not you, the bank, and then that's it. There's no more business. So you have to go after the next deal. So in order to have a good business, you have to constantly be pitching new companies on transactions. You go to companies and say, I think it's a great idea for you to buy this other company. Or I think it's a great idea for you to go public next year. And you're preparing these pretty in-depth pitch books to explain why you think it's a good transaction for that company. And you're doing this all day long. Okay. Some of the other things you're doing is you're attending meetings with senior bankers. You're taking notes. You don't usually talk that much, but you're taking notes. You're calling clients to get information, what we call due diligence. Again, when you're financial modeling, there's some things you need to understand. You're calling the company to understand it. And you're participating in conference calls with clients. And when I say with clients, I mean CEOs and CFOs, pretty high level people. So you're just out of school and you're sitting, it's not unusual for you to be on a call or sitting next to the CEO or CFO of a major company, right? You're also on calls with lawyers and other bankers. So it's a pretty high level job. And lastly, you're doing anything a senior banker asks you to do, including running errands or photocopying. And, that just goes along with the territory. So what's it like to work inside an investment bank, right? As that analyst that I just described, what's the work culture like? Well, number one, I think you got this earlier. You operate at a very high level. You get to sit with very senior people. So that's a really exciting thing to have. There is, however, a ton of work, and I mean a ton of work, long hours, a lot of pressure. Think of a normal work week, 9 to 5, Monday through Friday. That's a 40-hour work week. At the minimum, as an analyst in a 2-year banking program, at the minimum, you would probably be working 80 hours a week. Most likely, somewhere between 100 to 120 hours a week. Now, you're probably processing this in your head right now, and you're thinking to yourself, wait a second, if that's the case, I'm in the office all day. You are correct. You are in the office all day. Okay? Now, The upside is you get to work with a lot of smart people, and I mean really smart. Some of the people who mentored me, I still consider to this day, after all the business I've done with a whole bunch of different people, I still consider them to be some of the smartest people I've ever met. So you learn a lot. You learn a lot. Deals are 24/7, so you're on call. There are no such things as vacation. You can take a vacation, but you can get called back, right? So I remember getting called out of Thanksgiving meal because a deal was in progress and they called me back to the office to work. So there's not much social life except for those that you work with, unfortunately. And I know that for you guys, that must be like the kiss of death, right? For a young person. But you gotta give something to get something, as they say. You do develop great financial skills that allow you to access other careers, and if you don't, even if you don't do investment banking, other fields. This is a great fundamental training for you to go into other areas. People are very tough on you. You have to have thick skin. Investment banking is not a comfortable, nice environment. It's a very high paced, stressed, or stressful environment. It's not that people are bad people. It's just that deals are very demanding, so the expectation is very high, and you need to be on your toes all the time. At the junior level, your value in a firm is how good you are at your job, i.e., financial modeling. At the senior level, when you get up the ranks, your value is how much money you bring in, right? How much money you generate for the firm. Otherwise, you're gone. At the junior or senior level, if you don't deliver those two things, you're gone. It's very simple. That's just how Wall Street works. Some people don't like it, but it is what it is. Now, the question I get asked all the time, how much do you get paid? Good question. Well, I put up two charts here. So the left chart is the average Wall Street compensation. I think this probably represents a more broad-based average, meaning small investment banks all the way to large investment banks averaged in. I think more relevant is the right side where you see the investment banker salary plus bonus. That's probably more in line with what a big bank would pay you, like a Citigroup or Goldman or Morgan Stanley. So first year out of college, you're making 70 to 150,000 a year, and that's including the bonus, right? So that's including a bonus at the year end. The analyst program is 2 years. So sometimes you get invited to a third year to stay as an analyst, but most people leave. Most people leave and they either go on to other careers, or they go do something else, or they go to business school for 2 years and get their MBA, and then they come back. Now, when you come back, you've got, 4 or 5 years already out of school, and you become a first year associate. And as a first year associate, you start at somewhere between 150 to 350, including bonus. By the third year as an associate, you're making 250 to 500, right? And typically you stay as an associate for 3-4 years, and then you become the VP. And a VP is really kind of the senior guy on the deal team. He or she really runs the show, right? And inside the investment bank is a very important position, and they're already kind of I wouldn't say senior, but mid to senior level person. And they can make anywhere from 350,000 to 1.5 million on a good year with bonus, right? And now you've spent call it 3, 4, 5 years as a vice president, and you're up for managing director. So you're probably somewhere between 33 and 36 years old, something like that, and you're up to be, nominated as a managing director. And if you get there and the firm makes you an MD, you're kind of running the show, right? You're running a show and you're making a lot of money. Now, what's the difference between an MD and a partner? A partner is an MD that has an equity stake in the investment bank. So they're even more rare, right? So you're a managing director, or what we call an MD, for however many years, sometimes a long time. And then if you survive and you stay, the firm might offer you partnership and to say, well, you're going to be here for a much longer period. We're going to give you equity in the bank. And if that's the case, you're really doing very well in life. A partner at Goldman Sachs is a very, very wealthy person, right? So this is generally the track, the career track for an investment banker. Now you've seen the numbers and you're saying to yourself, how do I get into this racket? At least some of you are. Some of you are saying, how do I get, let me get into this business, man. Others of you are probably saying, no, 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 boy, this is just not for me. That's okay. That's okay. Everyone's got their own likes and dislikes. But if you're saying to yourself, how do I get into this? Well, here's my rule of thumb, right? I call it SAG, S-A-G-G, SAG. Study hard, ace the SATs, get good grades, get into a good college, right? Get into a good college. Now, any major, you don't have to worry about major. People ask me, what do I major in? You don't have to worry about major. You just need to be analytical minded. They're not looking for any particular major. Why? Give you an example. Someone who's a biology major, right? And you say, well, what does that have to do with Wall Street? Well, nothing, but if you're analytical, they love to have you because you can run their models, their financial models, and you know something about biology. Hey, how many biotech deals are there out, in Wall Street? A lot. And so now they have someone who is analytical, who they can teach to run the numbers, but also has a background in biology and can understand the fundamental business of the biotech company, right? So what you major in is not as important as getting into a good college, getting good grades, and being analytical minded. I'm sorry, I know this sounds like mom and dad, hey, I'm a parent myself, but that's just what it is. SAG is just what it is. There's no other formula than hard work and effort. That's as simple as that. Now, if you're in college already, make sure that you take every opportunity to build relationships, right? Build relationships with anyone you can connect with on Wall Street. That's really important. So get an internship in finance, get yourself close to the finance area in any way possible. Look for friends or family who know people in that business. Talk to them, ask them what they do, understand, what area that interests you in finance. Be aggressive. Ladies and gents, it was great to talk to you today. If you have any questions at all or any comments, ask away. Feel free. Don't be shy. Go into the questions channel and type your questions there. Address it to me. I'll do my best to respond quickly. And before I leave, I want to just, on a fun note, check out these movies. These are my favorite movies of all time, and they'll give you a good flavor for Wall Street. Yeah, bear in mind they're Hollywood movies, okay? So it can get a little dramatic, especially Wolf of Wall Street, if you guys seen that. It gets a little bit raunchy, but it's not too far off from the culture of Wall Street, all of these. So enjoy, and my personal favorite, of course, is Wall Street, the first version, 1987. So hopefully you'll like that as well. Okay, so see you next time, and I look forward to hearing from all of you.